Let's chat about property investing.
100%. Let's do it.
People love it.
Great Australian dream, right?
I know. Neither of us are in it. But we'll get to that in the conversation.
Equity Mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. If you've just joined us for the first time, a huge welcome. If you're feeling like you want to get up to speed with the basics of investing, check out our podcast, Get Started Investing. We also have a book to accompany it, so check that out as well. But with that said, let's crack on. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. This one, not about stock market investing per se, but you and I are both in our 30s. We're slowly growing up, and we would love to one day own a house. And that sometimes feels out of reach. And so the expert that we're speaking to today has an alternative to us buying in the very expensive Sydney housing market where we live.
Yeah, today is all about rentvesting. And this was an awesome interview. I genuinely learnt a lot throughout this. And I think we've both sort of changed our views on it. Well, not changed, but it's left us thinking a lot.
I didn't have a lot of view about rentvesting.
Fair call.
Yeah.
Now you do?
Well, yeah, it's really interesting. I mean, let's not front run the episode, but yeah.
Yeah, it was a great discussion. We sat down with Sam Gordon, who is the owner and director of Australian Property Scout. They're an investment buyers agency that is on a mission to retire 500 people by 2030. Now, this episode is sponsored by Australian Property Scout, and if you would like more information on building a property portfolio, you can reach out to them. The link will be in the show notes. They also do have a podcast called Scouting Australia Podcast. But Ren, let's get stuck in.
Let's do it. Before we do, an important reminder that any advice you hear on this show is general advice only. Whilst Equity Mates is licensed, we're not aware of your personal financial circumstances. So make sure you seek advice before making any investment decisions.
So Sam, welcome to Equity Mates.
Bryce, Alec, mate, thanks for having us here.
Now, we've got to start. The Australian Property Scout, which you're owner and director of, yes. You guys have a mission to retire 500 people by 2030. So are you one of those people?
So I retired myself before I actually started the business. So that was one of the really cool things. So I started the business back in 2019, right at the start of 2019. And at the end of 2017, I'd actually replaced enough of my income that I could kind of leave work and kind of went and traveled and stuff, which was really, really fun. But I got a bit bored. Like, it wasn't enough to live like the craziest, lifestyle sort of thing. I was backpacking and having a mad time. But at the end of the day, man, it wasn't enough to like live a crazy lifestyle on. So when I kind of came back after that trip, it was kind of over a 12-month window. I traveled about 9 to 10 months of that 12. And I was just pretty much looking for something else to do. And there's a few things I was tossing up. Real estate, builder, kind of a few different things, but then buying property was something I had a massive passion for. And I'd actually been burnt by someone in the same industry, like as a buyer's agent about 2 or 3 years earlier as well. And so, man, it just kept ticking over in my head as I was traveling. That it's like I should go back and be doing this as well. So, man, it's, I like to kind of walk the talk. I'm not someone who just likes to, talk about something I have no knowledge on. Definitely been there and done that and loved it. So
Sam, you said you retired in 2017. Well, you had enough to retire in 2017. You don't look that old. So either you got a great skincare routine or you've got a pretty aspirational story there. So tell us the story.
Yeah, man. Yeah. So I'm 33 now. So I was 27, 28-ish, I think, when this all kind of kicked off, like in terms of being able to travel, essentially on my terms and not have to work. Man, I bought my first property at 19. I'm funnily enough, I'm a farm boy from a few hours south of Sydney. Grew up on a small farm with my family. Used to trek into school and stuff. Left school at 16, literally high school dropout. Just started working, and then as I got a bit older, I started saving a bit of cash, and this was in the era. We're pretty similar era here because I'm 33, so I'm only a tad older than you boys, of like Fast and Furious, right, and all those sick Jap cars. And I used to go to school in Fairfield, a sports high in Fairfield, so I was just very big like Asian community, and so these Jap cars are everywhere. So I had this mad love for them. My dad was a mechanic by trade, and so we'd go out and we'd go and inspect these cars that I really wanted to buy, like Supras and Skylines and 200 SXs, all these things, and he'd just pick every single one apart. And then in the end, I just got sick of it, and he kept saying to me, "Mate, just go buy a house, And then it just clicked in my head one day. I'm like, why don't I go buy a house? Like, I knew a lot of people either made money in property or the super wealthy parked their wealth in property as well. I knew that even at a pretty young age. So yeah, I kind of started looking into it, realized that I could afford to buy something as well, and then bought my first one at 19. And pretty much it was a 2-bedroom unit in Wollongong for $275K, full renovator. Got myself a nice discount on the way in, just like always a bargain hunter my whole life. Did the renovation, and then when I was kind of going through that piece, I was at the dentist one day as I was doing the renos and stuff, and he was running late, and I'm never early, right? And for this one appointment, I was early and he was late, and there was this property investment mag sitting on the table, and I picked it up and I was reading it, and I probably read it for 10, 15 minutes, and mate, I was hooked. Left that appointment, asked him if I could take the mag. He's like, yeah, no worries. Took it, went to the newsagent, there was 3 magazines out at the time. Podcasts weren't as big. This is nearly 15 years ago. And then just absolutely devoured as much content as I could. And I joked that I kind of gave myself like a bachelor's in property because I just consumed so much content. And then I just trialed like strategy after strategy until I really, I guess, refined what I do now to a bit of an art form and a bit of like almost like an algorithm of what we chase when we go out and do deals. Yeah, and then pretty much just built an entire portfolio off the back of that. So it was pretty cool stuff.
Love it. Well, we're going to definitely pick into that algorithm in a minute, but we should address the here and now of Australian property. A lot of us are really struggling with housing affordability.
Including the two of us.
And I feel like I'm going to ask a lot of questions for a mate. What advice would you give someone like the two of us who are struggling to get into the housing market right now?
Yeah, so there's a few big things in Australia right now. Obviously, interest rates have been on a ridiculous run. We've had I think it's 12 interest rate increases over a 13-month window, like wild, right, in terms of how fast it's risen. So affordability has just completely dropped out of the market. Combine that with extremely tight stock right across the country as well, and super tight vacancy rates because there's no rental stock as well as sales stock. It is a really hard time to get in there. You boys are also based in Sydney, right? And I'm originally a Sydney boy myself. Sydney's been on this crazy run for the last 10 years. From 2013 to 2017, it doubled in its boom. And then the COVID boom went wild as well. And yeah, man, it's like, my honest advice would be, like, I wouldn't be looking to buy in your hometown. So, like, the idea of rent vesting is huge these days. Even myself, I used to be a homeowner. I always lived in my own home until, funnily enough, around that same window where I was able to replace enough of my income, I learned a little strategy. I know we're going to dive in a little bit about the rent vesting versus primary residence and owning it. But, yeah, man, just really learned how much better it is to rent vest and actually get that debt back, essentially, from an investing perspective, and then be able to go out and put that in the market instead. So I'd be looking to rent vest. Sydney's an extremely expensive place to live. Get out there and invest in other capital cities and big, strong regional centres and stuff like that. I'd be trying to build the wealth out there. Wait for Sydney to come back to be the right point in the cycle to buy, and then look to buy your primary residence when it's the right time to actually buy in Sydney again. And I've always been a big believer and a big advocate of that. Unless it's the right time to buy in a certain city for your own primary residence, I wouldn't be buying, because you buy the tail end of a boom. You could be waiting 10 years until you get any growth again. What's the actual point of holding that asset? You go make money somewhere else and then bring that money back and put it into the market, buy your own primary residence when the time's right.
It's such a mind warp though, because everyone always says, this year, particularly end of last year coming into this year, we're going to see correction 20%, across major cities. Yep. It's going to be good. I haven't seen it. Prices are still, it's incredibly competitive out there at the moment. It's one of those things over the last 10 years, it just keeps grinding up, and everyone has said probably for 15 years, there's going to be a crash, there's going to be a crash, and never comes. It's like, how do you just deal with that sort of mentality? Yeah,
man. I don't think a correction has definitely come. So Sydney did come back about 10 to 15% since the peak of early 2022. So in around about the 15-month window, it definitely has come back. If anything, maybe even an 18-month window since late 21. But the interesting thing, man, is like, it's not so much, and that's why I'm saying it's like, it may be 10 years until it's like the right time to invest again. And that's when affordability comes back around. So even if the market doesn't grow anymore, let's say it corrects by another 10, 20% and then just sits there and does nothing, there's actually no point holding that asset. It's from an investing perspective, there's no point holding that asset if it's not going to do anything for the next 7 to 10 years. Whereas instead, if you invested elsewhere and then brought it back in that window, man, even if it did correct that little bit and then plateaued for a while, it makes it a poor investment. Yeah, it's one of those funny things. I think the Australian housing market is resilient enough to not crash. I don't think it will ever crash. There's too much love for property. There's too much investment in property. But with where interest rates are now, there definitely will be some hurt. There will be some pain. But 10 to 20% in Sydney is huge. You know, if you're talking 20% on a $2 million house, that's $400,000. That's a lot of money.
Where's that happening though?
Well, it hasn't happened yet. Like,
wasn't there stories? I feel like you told me that in the back end of last year, Balmain had corrected like 25%.
Yeah.
And Balmain's, that's got to be a $4-5 million suburb, right?
Definitely.
Yeah.
So that's $1 million bucks.
Yeah. So much money.
Yeah, but this is where it's like this is where it's a wild thing, because like Sydney was never due for another boom, so it boomed and the unaffordability was there after 2017. The market corrected then, but then COVID drove it into another mini boom because no one sold. There was no one traded, no one sold, and stock was extremely tight.
Yeah, and interest rates were so low.
That was a big thing. Whereas now interest rates are so high, prices so high, there's no affordability. So it definitely will come back, but. Yeah, man, I'd probably be waiting a bit. Like you got to wait as well for interest rates to actually set in. One of the boys in the team asked me the other day, well, you said in a podcast the other day, like there should be all this hurt, right? Like why aren't people selling already? It's because the hurt hasn't really come in yet. And that's why they're talking about this fixed interest rate cliff that's coming off. People won't feel that until their interest rate rolls off, and then probably a few months after that, if not 6 months. Because if they're fixed at 1.99 and then roll off at 6, it'll hurt at first, but it still will take a bit of time for that to actually, you get 3-4 months of going from $2,000 a month to $6,000 a month. Like it's going to take a little bit for that to start to pinch. It's not an immediate effect. So I think that's important thing to note on that as well.
So you mentioned this term rent vesting. Yes. Let's unpack it because it is an interesting one. Bryce is from Wagga, and you've certainly said before that there's an attraction of renting in Sydney, buying in Wagga.
Yeah.
Unfortunately, I feel like Wagga prices went up a lot.
Wagga has also boomed. Well.
Yeah. Still more affordable though.
But yeah. But let's unpack the term for people who aren't familiar with it. Rent vesting. What is it?
So rent vesting, essentially, you're renting at the same time that you're investing. So you're not living in a primary residence. And I think that's one of the really big things. The important thing to note on this is the banks don't look at your house, your own home. They don't look at it as an asset. They look at it as a liability because it doesn't produce an income. So rent vesting, it's essentially you're renting. You don't have that big primary residence debt, and you're investing at the same time. So it's become massive, especially over probably the past 3 to 5 years. But it has become a trend over the last 10 years, really. That I've witnessed as well.
And so we want to understand the pros and cons of rent vesting versus owner occupier, because on one side you have the dream and want the security of having your own home and your own place to live. On the other side, you work so hard for your money, you want to put it to work and have an asset that over time is going to produce income.
Yeah.
From my understanding, one of the biggest advantages of rent vesting is being able to leverage the debt that is on there and to use that for tax advantages. But can you help us understand the pros and cons of each side?
Yeah. So essentially, I guess the point I made a second ago about like the debt level that the banks will look at of your primary residence, that's primary residence debt. So it's not investing debt, right? So they'll factor that in as a liability, not the same as like a car loan, but kind of in the same vein, like in a negative way, right? Whereas if it's investing debt, it's actually producing an income. So there's a very, very big discrepancy between the two. And it was something I learned back, literally that was the time that I was talking about where I was able to transition. I'd sold out of the Wollongong unit, funnily enough, the very first one I ever bought. I'd sold that and put that money back out into other properties and really started to build out some solid passive income. And at the same time, I actually moved out of the house that was my primary residence, and I was at a debt ceiling, so serviceability ceiling. And then I moved out of that and rented it, and went and rented something for almost exactly the same money, and my serviceability went up enough to buy another property. And so that was like the light bulb, that penny drop moment for me. I'm just like, hang on, what? Shouldn't it be the other way around? Like, shouldn't it actually work better for you to be in your primary residence? But it's because it doesn't produce an income. And when you're out renting something, the banks factor it in that if the worst thing happened, you could downgrade and go rent instead of 600 for 400 or something. Take a cut if you really needed to. Whereas with your own primary residence debt, they buffer rate you higher. So it's actually it's a big discrepancy and it's a big variance on that front as well. There's pros and cons both ways. I think the biggest pro is what you said before, the security and the stability of a primary residence. My biggest issue with it, and what I really realized a couple of years ago when I almost pulled the trigger, and every year, if you're doing well, I've been doing well in property for a while now, so your kind of aspirations keep changing every year, right? But if you trade let's say every couple of years, even every 3 or 5 years in terms of primary residence, because you can, instead of being able to afford the 750, now you can afford the 1.5. And now you've gone from 1.5 to 3, but maybe your dream home's 5 million. Every time you trade in and out of that asset, you've got stamp duty costs on the way in. $3 million house, you're talking $200,000 in stamp duty, 150, 200 grand, depending on your state. You got sales costs on the way out, similar sort of numbers, $60 to $100,000, depending where you are. So it's like, can be $250,000 in terms of in and out costs just for owning the asset. And if it's not your dream home, and this is what I've come to realize, if you're not going to buy your dream home as your primary residence, there isn't that much point owning it. Because yes, you have stability, but it depends what you're doing. If you are going out there and investing, it makes sense to rentvest until you can afford that dream home that you really want. If you're just going to live in a home and that's all you're going to have, it probably does make sense to buy it and pay it off if that's the avenue you want to go down. But like we're talking about investing, right? So like if investing's the aim of the game, I would be, and I literally am still now, I got a $24 million portfolio, ridiculous amount of passive income. I still rentvest because at the moment, what I want, I actually haven't even figured out exactly where I want to buy exactly. And when you start talking about a $5 million plus primary residence, you don't want to go buy something that you're not 100% set on, because the trading costs I was talking about before on 5 mil, you're talking like 300 grand stamps and like $100,000 sales costs on the way out. So it's huge costs to get in and out. So like, unless you know exactly what you want, exactly where you want to live, and you can afford that dream home, it actually, in my opinion, it just doesn't make sense to buy it. The idea of stability and security, it's like, yes, it is good. But if you can live in the same place and you've got to change every 2 years because you don't have as much stability, I see it as a very small cost. It's a pain in the ass to move, we all know it, but it's a small cost in terms of what you can do on the flip side instead of owning that primary residence. So, and I've witnessed that firsthand with what we've been able to do as well, I've been able to do, sorry.
Yeah, it's another mental dilemma of being like, finding the perfect place for now and just wanting to be in. And it feels like there's obviously different ways that you can achieve that.
Well, the other point on that as well, that's actually a great point, because what you can buy, most likely you could rent. Like if you can't afford exactly what you want to live in terms of buying, you could probably afford to rent there. And so one of the other massive trade-offs, I didn't mean to cut you off there as well, but one of the massive trade-offs with this is so often you can actually afford to rent in a far superior suburb to where you can normally afford to buy.
I feel like that's, you're living through that.
I'm living through that right now. Yeah, like wanting to buy where we live, and it's just increasingly becoming more difficult to buy where we live, and we would be settling on something that is we're buying it to get in with the knowledge that it's not going to be the dream home or anything like that. Yeah. And so then it's an interesting one, because speaking of the debt, you then have these conversations with your mortgage brokers or advisors, and they're kind of saying, if it's not going to be your one, you then need to think down the track, are you going to likely use that when you move out to rent out, keep it as an investment property? If so, then you need to keep your debt as high as possible, because then that debt turns into negatively gear it, and so it's all these things flying around to consider, and it's just like far out. Let's just move to Wagga. So
the farm out there just chill.
It's just too many. Yeah, but the thing that at the end of the day, it is just such a large amount of money that you really can't play around. You know what I mean?
You want a little bit of advice on that as well?
Yeah, well, we can take this offline.
Yeah. Well, I just tell you, dead honest, man, like where you and I would want to live, it's not the place where you and I should own investment properties. So like, if we're talking $1 million suburbs, especially $1 million suburbs in Sydney, they are for the ultra wealthy. In my opinion, no one else should be owning them, because they are not a great investment. They will bleed you way too much. Like you look at, if we ran the cash flows on the place that you could afford to buy right now to live in, and then you run the cash flows on it as an investment, dude, it's probably cost you 40, 50 grand a year to hold that. Which means if you have to wait 10 years until the next cycle, you're $400,000 to $500,000 in the red, not even taking inflation into account, just talking negative cash flow until the next cycle kicks off. It's not a good investment. Like holding something like that, it's not a good investment. That's why you're better off building your wealth somewhere else, and then coming back and being able to, and buying that when it's actually the right time to buy in Sydney, because you're going to get the double whammy. The beautiful part of primary residence, the best part of primary residence, there's no capital gains, right? So if you're going to buy in Sydney before it booms next. Like that's the time to do it, not at the end of 10 years of like the biggest growth cycle we've ever seen. It's a time to like walk away from Sydney, rent where you really want to live, and go invest somewhere else.
I need to bring my wife in.
Send her the potty. Send her the potty.
So I want to get to where we should be looking, because I think a lot of people will be interested in that question. But a couple of questions about the pros and cons of rent vesting v. occupied before then.
Yep.
I think one of the most common things you hear from people who are, all in on buying property is that rent money is dead money. So, for
the old adage of our parents' generation.
Yeah. So
yes.
how do you respond to that when we're talking about rent vesting?
Oh man, it's I would ask them to please show me their portfolio and how well they've done in property. I literally don't take advice from anyone that has not done what I want to do, or what I've done on my level. If you're going to take advice from someone, get them to show you the books of what they've actually done before. It's so many of these old adages and sayings from our parents' generation that are so wrong. They also say that you should never sell property. And if you never sell property, this goes in the strategy of what we do at Australian Property Scout. If you never sell property, it'll take you like 30, 40 years to retire. But if you build a portfolio that some of it's generated towards cash flow and some of it's generated towards growth, and you see significant growth, you sell it, you bank the profit, and you pay out your cash flow deals, you can retire in an extremely short window of time. And this is where it's like so many of these sayings and these things that our parents' generation talk about. That's why they're all retiring at 70, or some young, some 60s, some 70s, and it's because they hold on to these beliefs that their parents told them that are incorrect. Like, in my opinion, dude, like you want to be listening to the people that have done what you want to do. Rent money is dead money. It's like, yeah.
So just talk us through the maths, because it is. I'm just trying to get my head around it. So let's say we take Bryce's situation. I love how we can just use as an example.
Great. Free advice.
Bryce buys a place in Wagga, rents it out, gets income, and then services the mortgage in Wagga.
Yep.
Let's assume that the rental income there doesn't quite cover the mortgage.
Okay.
And then in Sydney, he's paying rent.
Yep.
So the rent he's paying in Sydney is more than the rent he's getting in Wagga.
Yep.
So there'd be a gap there, and then he's got to service the mortgage as well. Is that...
Yeah, like I wouldn't even be taking into account the fact that it's more expensive to rent in Sydney compared to what it costs to hold the property or the rental income that comes from Wagga. I would be looking at the Wagga investment as a standalone investment, because where you live and what you're doing, that's almost like a separate entity or separate to what you're doing. So
separate them.
100%, man. So like, and I would be looking at that more as how much are you saving renting compared to owning it? Because if owning it's costing you, let's just throw figures, right? $100,000 a year to own it with your now interest rates at 6% principal and interest, pretty big. Council rates, water rates, all that sort of stuff that you cop as an owner. Let's say you're sitting at 100,000, but to rent, let's say it's 50 or 70 or 70,000.
So it's cash flow.
Yeah, and I would be looking at that. And because the banks look at the cash flow, right? They look at the income coming in and going out. And so if there's 100,000 with no rental compared to 60, 70,000, which is your, say, primary residence compared to what you rent, they look at that. That's additional servicing. And it's not only that gap, it's a different calculation even entirely, because instead of them factoring it like that, they actually probably will factor an extra 20 in on top of it, because it's primary residence debt, which is non-tax deductible. It's not producing an income. So again, it's a liability. It's not an asset. So it's a far superior situation on that. And that's where I wouldn't even bring Wagga into the equation, because that's the investing portfolio.
Yeah. So just you just mentioned tax there. So that's actually something that it would be good to get my head around. Okay. So investing debt, if you've got debt to earn an income, that the interest you pay on that debt is tax deductible.
Yes.
If for your primary residence, it's not tax deductible.
Okay. So the difference is it isn't, unless you do an equity release on top. So let's say you had a $1 million loan, your property's worth $2 million, that's your primary residence debt, and then you pull out, let's just say you pull out $500,000 purely for investing purposes. Obviously, you guys probably put disclaimers in. This is not financial advice, but essentially,
you don't need a financial services license in property.
No, you don't. I gotta say you don't. Still always wary about. Still always wary. Beautiful. So, like, let's say you're sitting at $1 million, property's $1 million debt, primary residence debt, right? And then your property's worth $2 million, and then you go pull out the $500,000. Let's say 75% LVR on that is $500,000. It's up to $1.5 million. If you pull that out and do not touch it for anything else, that is investing debt. And if all you use it for is investing, yes, you can fully write that off. You can't write off the 1 mil, but you can write off the $500,000 interest cost. One of the other cool things is if you have that sitting in offset account or redraw or whatever, you don't actually pay the interest on it except for what you use. So you can literally have the whole thing sitting in there. It's almost like, bullets in the chamber, ready to pull the trigger. And that's what I always have a large sum of equity or cash sitting there ready to go and deploy into the market and start putting it to work.
Yeah, again, another toss-up. Like
so many equations.
Using.
It's all right, boys. It's all right.
It's like using deposit at its maximum, or just putting in the minimum deposit required and sitting the rest in offset.
So it always depends on the individual. Are we talking primary residence or investing?
For this sake, primary residence. Asking for a friend.
Okay, asking for a friend. Man, it's always an individual situation, right? And it depends how much you've got. If you had enough for like a 40% deposit, I'd be looking at the interest rates of like a 60 to 70% LVR, 70 to 80. If you had no plans to invest, this is if you were just purely buying the primary residence, because your rates are lower, the lower your LVR is. So it'd be worth looking at. But if they weren't considerably lower and you were wanting to invest, I'd be buying at 80% LVR. I'd just be sitting the rest in offset. If it's a minimal difference, you're better off doing that because, again, bullets in the chamber, keeping the gunpowder dry for when you're ready to go pull the trigger on something.
Mm. Anyway, back to what we were talking about.
I reckon let's get to the question of, for all those people living in a place like Sydney, Melbourne, wherever that they can't afford and they're interested in where the best rent vesting opportunities are. What are you seeing at the moment? What are the towns, cities, locations we should be thinking about?
So, as a little caveat, I'm always very cagey on locations. When I jump. Yeah. So I'll throw that out. I'll give you a little bit though. So essentially, the way that we just because that's what people pay us for, right? In terms of the IP. What I'd be looking for and what we look for out there at the moment is areas that are affordable relative to incomes, right? So if you look at Sydney and Melbourne, huge. The income to house price ratio is massive, right? In some suburbs, it's like 15 times the median income of that area to house price. Wild, right? Like absolutely crazy. And when you go and throw in interest rates doing a 4% increase in a little over 12 months, affordability gone. If you turn that on its head and look for the other locations and this is where I was talking before about cycles. And that's why I don't think the idea of buying in Sydney is smart for now, because I feel like the cycle will come back around where that affordability comes back a lot, right? So that's where I would be looking to kind of come back into Sydney at that point down the track. But if you look instead at the other cities that are at their point in the cycle where they're actually quite affordable and quite low, that gives them a lot of room for propensity for growth. If you combine that with areas that then also have big infrastructure plans, big projects going on, super, super tight housing market, sub 1% vacancy rate, all these different things and factors that are really aligning for a great run and a great market. Yeah, essentially a great market run. They're the areas I'd be targeting. So there's a huge amount of regionals that really tick the boxes on that didn't boom during COVID. That's the caveat on that. A lot of people, like Wagga, man, went crazy. A lot of the regional hubs around Sydney and Melbourne, a lot of the cities really, but especially Sydney and Melbourne, because they were so much cheaper than the capitals. And Sydney and Melbourne, like during lockdowns, were terrible. Like I was here during it as well. It's one of the big reasons I moved. And it was terrible, right? So many people tried to get out. But a lot of those areas, especially in vicinity, had massive booms. I'm originally a Southern Highlands boy. Like I grew up down that way, and I had a bit of property down there. And literally the tail end of that in 21, I knew that there was going to be a market shift as COVID started to ease. When they pretty much just said, we're never getting back to zero, it's going to be as is. I took a couple of properties to market because I knew it was immediately going to ease. And some of the stuff I'd bought down there had doubled again. So it had doubled in 2013, 2017, it doubled again in the COVID boom. So stuff I bought sub like 350, 370 was now worth like 1.2 mil in a 10-year window. It was wild. But it wasn't realistic. Like it was an inflated boom. So I took them to market, right? So they're the sort of areas you could be really careful of. And the regional areas, they haven't felt the full pinch of it yet of that come off. A lot of them have, but not in the way that they probably will. So again, there's all these layers of like what you look at and what you need to be careful of. Capital city wise, like I'll give you a couple of things here.
Yeah, no.
I like Brisbane, Adelaide, and Perth. They're both still quite affordable for what they are. I still think they've got a fair bit of run left in the tank. Income to house price ratio is very good, and there's a lot of projects going on in the different areas there. So you kind of be honing in on those different areas and really picking apart the best ones there. The regionals I can't really give you too much because they're so isolated. You know what I mean, housing market wise, but. I'd go back to my point before, not the ones that were booming because of a COVID boom, the ones that have really strong individual economies and almost, if anything, didn't boom off that because they have, again, more room to grow.
I always used to hear Tasmania thrown around as a place for rent vesting. I don't know if that's come off.
Tassie went crazy, man. Tassie went crazy 2015 to 2020, but it has come off since then as well.
It was probably
even actually through COVID as well. So 2021, early 22.
Yeah, I think it was
big run.
When we were at uni that I first started hearing Tassie. If it went crazy from 2015 to 2022, we just could have got on at the start of it and we completely missed it.
Right at the start.
I often think back about early days of grad and stuff and like what our serviceability would have been versus obviously deposit aside, but like the prices of housing back even 6 or 7 years ago, like far out. If you just got into a $300,000 something and then Anyway, what could it be? I reckon what we should do is just start listing regional places and see if Sam says yes or no.
So Bryce, we went to uni in Canberra, Bryce, and we could even feel it at the time in like the mid 2010s that there was a lot of building and a lot of stuff happening. We were in a shitty student house and all the houses around us were getting renovated. And
going through gentrification.
But Bryce went back like a couple of weekends ago and you were blown
Loved
away.
it.
So what are your thoughts on Canberra?
Canberra's another one it's actually had a really, really long run. I think because it's such a condensed housing market with so much government like employees. So it's such a huge income city really. Canberra's a tough one for me because yields are so soft. I don't like to invest anywhere that's got super soft yields. I think it could still keep going okay, but it's not going to shoot the lights out. So there's different levels of different ways of investing. The way that we invest isn't a blue chip style, right? So we don't go park it in something and hope for 3, 4, 5% growth, maybe 7% growth annually over a 10-year window. What we like to do is position ourselves early in a market just before a market goes. So we're always looking for those markets at the bottom of cycles. If you bought something in Sydney now, in 15 years, you probably have done all right, yeah? But like, if you go put that money in somewhere else now, you probably could double it. And you could cash out in 5 years and probably go double it again before Sydney starts its next cycle. And so that is the way that I like to invest, and that's the way that I would be investing. So I personally am not one to look for ones that are like plotters and will like go okay over the long term. I like to look for the ones that are severely undervalued and have that really good chance of a massive upswing. So like if you look at even like Brisbane and Adelaide, they've both still got run left in the tank, but we got in quite early, 2018, 2019, 2020, and then those markets really started to kick off 2020, 21. They've still got run left in the tank as well, but we're positioning ourselves before the waves. Like a lot of our guys have got in super early and we bought really cheap, bought really well. There's plenty of guys there, and myself included, have doubled money in those markets since then as well, in literally less than 5 years, and not doubled capital doubled house price. So if you look at if we talk about the equity and like how much you've actually put into the deal, let's say you put 100,000 into a deal worth 400, and that 400 is now even 6, 7, 800,000. Your growth your growth obviously on the house price, but your growth is on the capital you've put in. So if you've gone from 4 to 7, $300,000 growth on 100 grand, like that's a pretty good return. So that's why I always like to look at it. And literally, you can strip that 100 out after the first couple of years of growth. You can strip that out and go roll it elsewhere. What's your ROI when you're continually stripping equity and rolling into deals as well? So I should work mine out one day because when I was 19 and bought my first, I was making 35 grand a year. I put in like a $25,000 deposit, and I never made that much money before I obviously started the business, and I do well now. But like before that, I never made that much money. I'd love to work out the ROI on pulling money out of deals and what that initial capital bought me. So
for someone listening at the moment and thinking, this sounds great. When you're looking to rentvest or invest, should we be optimizing for income or optimizing for growth to kind of get started?
From the deal?
From the investment.
Okay. just to break one thing down, right? Rent vesting is the strategy.
Yeah,
Rent vesting isn't like going and buying somewhere. Rent vesting is like, I'm going to rent vest, so I'm going to be renting where I am and investing somewhere else, right? Okay, actually, to answer that question, it's a couple of things, because the way I always assess a client's portfolio or a client's position when they come in, let's say they got nothing and they're coming in with 100 grand income with $100,000 savings or something like that, you're going to run out of capital before you run out of serviceability. So for that person, we need to make sure we're putting them in a good, strong growth location, making them a bit of a discount on the way in so they can strip that equity and get into the next deal sooner. If someone comes in with $500,000, but they're making 100 grand a year, they'll run out of serviceability before they run out of capital because they've got so much. It's a different strategy. So you go and target cash flow deals. And one of the really important things to note is a lot of people, you remember years ago, you guys would have heard about this, we're same age, right? Remember years ago, people were like, oh, you buy 10 properties, one a year, and then in 10 years, you sell half, you own the other half outright. The big fella, you remember that?
I don't remember that.
Oh, man.
Yeah.
Oh, I always read it everywhere.
Stock market blinkers.
Oh, okay. Man, it was huge for years, right? Everyone always talked about it. And the issue was everyone was doing it on like a $300,000-$400,000 investment with a standard yield. And it's like, when you get to the back end of it, the net cash flows are so average because all you've done is buy a standard house. Like, yes, if you bought in the right areas, you would have had great growth and all that. But like your net cash flows are average. So the way that I always look at it is you invest for growth with a decent yield, so it kind of takes care of itself, right? So you invest, but the property predominantly and primarily is there for growth. And then you also go out and you invest for cash flow. Even if you, and they're two different property types, growth property, cash flow deal. The cash flow deal is still in a growth area and the growth property has still got a decent yield and a decent cash flow, but they're in the portfolio for two completely different things. This is where a lot of people get it wrong. They go all ham for the cash flow and they run out of capital and they're cooked. Or they go all ham for growth and they run out of serviceability and they're done. You need to build a portfolio with a balance. And then really what you want to do is you want to keep structuring and building it like that, balance as much as possible, keep pushing yourself, keep leveraging as much as you can to build this out, with the whole idea that when you get to the back end, the growth properties, going against what our parents used to say of never sell, when those growth properties have their growth cycle and they essentially peak out, you're wanting to sell them down, clear the debt, bank the profit, and with that profit, use it to pay out the debt of the cash flow deals. And so if you're building them almost in unison, let's say you're doing one for one, and every growth property, it's literally there to recycle equity to buy the next one. But then let's say that's only $60,000, $70,000, $80,000 to pull that out. The rest of the profit in that deal is literally in there to pay out one of the cash flow deals that it's paired up with. As you go through and you build out that portfolio, when you start going through your sell down phase and your debt consolidation phase, you're not just selling down a growth property to pay out a growth property with an average yield. You're selling something down to pay out something with a much higher net yield. And so if you give a simple scenario of, let's say, a deal for 400,000 that's, I don't know, renting for 400 a week, right? So 5% yield, which could be a great growth property, could be a great growth location. And that's a normal yield, normal-ish yield, right? In today's market. That thing after all costs would only be yielding you, like that's 20 grand a year in rent. But after your holding costs, you're probably only sitting at 15,000. You got 5 of them, that's what, 75,000 a year. But if instead you did dual income or triple income on one title, in your cash flow deals, and you paired them up, and maybe instead of 400, they were 500 or something like that. But you've got the same number. Let's say you still had the 5 of those deals. Instead of sitting at 15 grand per property, 75,000 total from 5 deals, you'd be sitting, let's say you had, maybe around an 8% plus yield or something like that, 7.5%, 8% yield on a deal like that. You're going to be sitting maybe at $30,000, 25 to 30K per annum net passive per deal once it's paid off. So instead of 75K and having all these things and very exposed from a very low cash flow level, you got these things that are really high net cash flows, and you might be sitting at 125 to 150K net passive from the same number of deals.
You make it sound so simple.
I know.
My biggest question is, where is paying 8% rental yield these days?
So what we do,
we're going to have to pay him to find out.
I'll send you the agency
Brisbane,
agreement.
Adelaide.
Yeah,
So
I swear it's Sydney.
Yeah, not in Sydney. It's like a 20-room hostel, something like that. Nah, so like it's what we do is what we call manufactured cash flow deals, right? So we'll go. That's why I said kind of like 2 or 3 rentals on one title. So like the simplest way, and you boys been in Sydney, surely you would know at least about. I know you don't do much property, but granny flats, right? Yeah. Simplest strategy when it comes to this, and actually quite effective if you're doing it in the right location, is something like a granny flat. And so you're getting you're building something brand new at the back, so you've got depreciation, you've got very low maintenance costs, and very easy to rent as well. So you've got 2 rental incomes on one title. And so on that one title is the key, because you've got one council. You don't have 2 council rates. And that's that net holding cost of the singular asset is where you lose so much, because you always have council, you always have water, insurance, all this sort of stuff that's at full freight on a singular property, singular tenanted property. When you have your dual and your triple incomed assets on one title, you literally have that one set of council rates, even if it's a slight top up. Water rates you pass on the usage to the tenant anyway. Insurance, a lot of the time, you literally just increase your building insurance, which might cost $100, $200 a year, and then a second landlord's policy, which might be $300, $400 a year. So it's like a very incremental, small net holding cost addition. Might be another $1,000, but you've added this entirely new rental income stream on top.
So here's the question: what's the most number of granny flats you've ever put on one property?
Yeah, you can. I wish you could do heaps, but normally you're limited to the one. But sometimes you can do advanced strategies and turn the front house into like a dual income, a dual rental on that, and then still have the granny out the back. But they're very like state dependent, and that's just like one strategy out of many. We also do duplexes, triplexes, unit blocks, things like that we help clients with too. The beautiful part of those, and the same as say the granny style development too, is you have, from a land tax perspective, right? So a lot of people, they start racking up a fair few deals, they start racking up land tax. Again, you go back to the singular asset. If you just got that one property, it's that one set of land tax to achieve, one set of like rateable land value, which is a fair bit of exposure if you have to rack up heaps of those to get your net cash flow position. But on your higher cash flow deals, you need a lot less of them, which is a lot less of a rateable land value exposure to achieve the same net income. So this is a lot of, I realized this very early on, where like, I was like, I'm not getting enough from these singular purchases. And that's where I started, because I was a very low income earner. I had to look for these higher cash flow plays that would take me to that different level. That's when I started really discovering and uncovering all this stuff, all the grannies, duplexes, unit blocks.
So Sam, obviously you know that we're looking for houses at the moment, and through our broker, there's he's kind of advised on what you should be looking for, even though it's an owner occupied, just to ensure that when you do go to sell, you're giving yourself the best chance to have put yourself in a good position.
Yeah.
What are some of the like non-negotiables for you when it comes to like looking for features of a house, location, those sorts of things from a either invest or owner? Like, does it face north?
Yeah.
That's a classic.
That is a classic.
Aspect. North facing.
I
Such
like
a premium on north facing.
Schools.
Yeah.
It always comes down to what it is, right? So when it's primary residence, it's a very, very different basket. And so primary residence, all that stuff's super important. It's probably more super important from a desirability perspective as opposed to a growth perspective. And I think the one thing to note on that is you may be able to buy somewhere that you really like that doesn't have the schools, isn't north facing, blah, 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 all the stuff, but the suburb that you really like, and maybe pay in a primary residence maybe $500,000 less. The growth in that suburb will be the same, right? So it's not going to grow by considerably more because you buy the best one. It'll grow at the same level, but relative to what the value is of that property, it will grow in line with that. So that's why from an investing perspective and an owner occupied, it's a bit different. Really goes to the suburb you want to get in and what you can afford. When it comes to an investing side, man, I'm actually a really firm believer of I guess what I said just then, in the sense of like your growth rate will essentially be the same. Even though it will be more desirable, will always be more desirable. It will always be more desirable, but people will always pay premium for it now, or whether it's in 5 years. So you're going to pay that premium now as well, and your growth rate will be the same. So the funny part of this, and I've butted heads with a lot of people on their blue chips and always going for that sort of stuff, from an investing perspective, your chance for growth is actually higher on the cheaper ones because they're less desirable, there's less competition. You can normally actually get a better deal. And so let's say you pick it up at a better discount, your growth rate is actually better than the one that's at a premium that you can't get a discount because it's so desirable. So from an investing perspective, that's the way that we look at things. And we don't invest in multi-million-dollar suburbs. So it's a little different from our end. But when it comes to investing, man, I take those into account, but then like not non-negotiables for me. For me, the non-negotiables are the correct market and the correct market cycle. You buy in the right market will do 80, 90% of the heavy lifting, So like get the market wrong. It's the same way. Like that's where you'll do yourself out of majority of your growth because you're buying in the wrong market. For us, we're always looking for like the little value adds. Like, can we convert something or add something to create an extra bedroom and bathroom? Is there something that we can do a cosmetic facelift on these different things for? So we kind of look more for the manufactured routes down that avenue. That's because that's really the way that I built my portfolio. I know it works. But it doesn't really come down to, I guess, like the different stuff that it would from an owner-occupier perspective. So we're always looking for that value add. When we're building portfolios as well, we typically are always looking to try and make a bit of a discount on the way in as well. 12 months ago, 24 months ago during COVID, it was every year kind of back from now, it was a lot easier. Where we are right now with stock as tight as it is, it's extremely hard to get like really good discounts. We still do it, but it's a lot harder than it was back in the day. I would be feeling for the average punter going out there trying to start their portfolio now, doing it themselves, because stock's so tight. Majority of what we do is off market. We, at the moment, over 90% of what we transact on every month is off market. It's that tight.
I've just got one question on that. Obviously, that would be one of the biggest benefits of having a buyer's agent.
Yes.
Yeah, is the off-market access.
Yeah, definitely. It's also understanding market value. So if we actually even go back to yours before, the average person who maybe doesn't understand aspects of a property or location or anything like that, whether it's for the really expensive ones or the cheap ones, that market knowledge, that person should have really, really good deep market knowledge. Like we actually get on the ground. I'm actually on Sunday flying to interstate.
Almost got him. Almost got him.
Holy shit, that was close. I've never been that close before. So like we're flying interstate like with a bunch of us, right? And getting on the ground. And getting on the ground for a full week, right? And we do that regularly. So we normally do that once a quarter. And it's, from an investing perspective, most buyer's agents won't do that. But you don't understand a market well enough unless you're doing it. And so, yeah, man, it's very important from that end to understand market value, even down to the street level and to the suburb level as well, within a council or within a state, a city, whatever. So that should be kind of the primary thing. And then also it's getting access to so much more. Like, man, the average punter that at the moment in all our markets that we're in, if we haven't seen it, someone else has seen it as well, potentially. Almost everything that's gone to market, someone's passed on it. Right now, because the market's so tight, everything has probably been passed on that's hitting the open net. So if it's been passed on, it means it's probably too expensive or there's something wrong with the deal. So when you kind of factor that in at the moment, yeah, man, the off markets are a huge part of it. But again, it's understanding the value. Just because off market doesn't mean it's a great deal. You got to understand it really from a deeper level as well.
We should ask. So that's like the reason why you want to buy as agent. But you mentioned earlier that you had a bad experience with a buyer's agent.
Yeah.
So I guess what are the watch outs? What are the red flags? What are the things to avoid? Not with you guys, but with other buyer's agents.
No, man, it is a great question, dude. Because like the fella that I got burnt by, man, I grew up reading about him in the magazine. So like he was like my idol, man. But his business had turned into this huge volume game. And so, I mean, I signed on and this is where we actually, here you go. Here's one of your key ones. How much do they charge? Like what's their fee structure? So for them at the time, it was 9,900. This was 6 years ago. I was only making 70 grand a year or something. It was 9,900 up front. So if someone's charging you the whole fee up front, you got to ask why, because what's their incentive to actually do a great job? That should have been my red flag, but I was a lot younger, naive, and didn't really pick up on the fact that was. I never asked any other buyers agents, so I didn't know if that was the norm. I just thought 100% I was going with this guy. So we split our fee up. We got a very small upfront, and then the balance is the balance is due on completion, essentially on settlement of a deal, because it leaves skin in the game. It leaves essentially the dollars on the table to actually have to earn your right and earn your crust essentially of doing a good job. They're the big ones. I'd say go online, but the issue is I've looked at this guy before, like recently as well, and like they kind of scrap the old accounts and start the new stuff. And so like the review side of things, you still should be able to find bad reviews on people if they've done bad jobs, but it is a bit harder to find on that front as well. But yeah, man, you have a good look around from that end and kind of ask around that fee structure as well. One of the big things is like asking the questions in terms of what you're trying to achieve as an investor. Have they done that themselves as well? There are a lot of buyers agents that have popped up in the last 1 to 2 years that have literally done a course. They think you can just go buy off the internet and they have no actual understanding. They've never bought property or they only own a couple of properties, and nothing against them from their investing perspective. That's fine. But exactly as you joked about earlier in terms of it's an extremely unregulated industry, I don't think someone should be paying them a substantial amount of money when they don't have the experience or they don't really know what they're doing in that end as well. So the experience is a really big one, the fee structure, and yeah, probably the review side of things as well.
Yeah, nice. That's some good tips. So my last question, like I find it really interesting, this whole idea of Rentvesting, but the last 10 years, hell, the last 30 years in Australia has just been almost an uninterrupted bull market. Does this if the market trades sideways for a while, or even if it trends down for a while, and I'm not saying like 2008 style catastrophic crash in the US, but just like prices come down to go in line with affordability, does the strategy work still? Like, or how does it change?
Can I ask you an interesting one? You said there, it's been like for the last 30 years, it's been a wild, like a bull run, right? What market are you referring to in particular?
Or just Australia as a whole?
Right. So,
I understand that there's like different sub-markets.
Yeah. Well, that's why it's an interesting comment, right? Because like a lot of people said that, and it's a funny thing, man, because I remember seeing like buyers agents and actual people who were deemed as like professionals in the industry after Sydney and Melbourne finished their run in 2017 saying we'll never see another boom like the Sydney boom. And then a couple of years later, well, actually at that exact time, you guys were laughing about Tassie before. Man, it was in the middle of a crazy boom it hadn't seen in 15 years. But the reason I ask about like what market you're talking about is because everyone calls like Sydney is king, you know, it has all this crazy growth and it never stops and the rest of it. Man, everyone's got such a short memory because the last 10 years has been wild, but the 10 years before that, 2003 to 2013, Sydney trend sideways. It came back. In 2003, you paid more in 2003 than what you could buy a property for in 2012, 2013.
Really?
So that's what I was saying before, man. Like, and literally, dude, have a look at like a 20, 30-year trend and look at the way markets move in cycles. Like, a lot of people say cycles, a load of shit and all the rest of it. Mate, have a look at like a 20, 30-year trend. Don't just look at the last 10 years. Almost every market has seen a 10 to 15 year flat or sideways period. But if you look at 2003 to 2013, have a look. Sydney trended sideways, came back. Have a look at Brizzy, Adelaide, Perth. What did they do in that time? They all doubled or more, right? But in the last 10 years or the between 2007 to 2020, they all went sideways and did nothing. So that's why like I'm talking before about that example of I would be looking at where can I double my money in the next 5 years? And then where can I double it again in the 5 years after that? And then I'd probably come back to Sydney. And I'm a Sydney boy originally, and I've made great money here. But I understand the market is cooked, and it is unaffordable. And I do not see any way up in the next 5 to 10 years. I honestly don't. But if you look at those long-term averages and see how they sit, that's why I laugh because so many people that like big names in the industry have said it. And I'm just like, dude, how can you say that? Like if you look at those long-term trends, it's so obvious the way that it plays out. And obviously, like I'm a property, bull. You know what I mean? Like I love it on that end, so I know from that end. But yeah, that's all I'd say. Is stress. Have a look at that, and I think you'll be surprised, man. And there are a lot of graphs out there around it as well that show that breakdown of that lull period, and then all the other markets peaking in that time as well. So it'll be an interesting read for you, man.
Fascinating.
Well, I guess I'm going to have to take one for the team, become a client, then come back on the show and tell everyone where the regional areas are.
I'll put a non-NDA in his one.
No, but as soon as you're as a client, you're not going to want anyone else to know.
Then
That's it. Nah, because that's it, man. Because like literally, dude, that's exactly what it is. Because like I try and keep where we buy under wraps for as long as possible because it allows us to get the best deals and the biggest discounts for as long as possible. And then when areas start to go nuts, that's where we don't really care so much because us and our clients have made so much money in those times. They've bought in early. They've made discounts. The market started on a bull run. That's perfect. It's fine to kind of talk about it at that point.
Yeah. Then you want to pump it up. Then you go on
100%.
podcasts.
Yeah, man. So it's a funny thing, eh? So it's people always laugh about how cagey I'm about it, but it's because like we're very diligent on what we buy, and man, I handle every deal that comes through the business. We're pretty decent size now. We are one of the biggest BAs in the country now, but I still handle every deal that comes through because of the experience of me getting burned back in the day as well. Every property for every client is crucial. Like if one person gets a dud or overpays for something or buys in the wrong market, like it's terrible for that person. You know what I mean? And I wasn't just that only person, but obviously was in there it was a volume game that they played in there. So yeah, man, very diligent on that front, and I guess that's why I'm so protective on it as well.
Well, if you'd like more information or if you'd like more some help from Sam and the team, reach out to Australian Property Scout. They've supported this episode, so thank you so much. They can assist with building your portfolio. They also have their own podcast called Scouting Australia Podcast.
That's the one.
with I imagine plenty more tips and lessons and everything that we've spoken about today. But I've genuinely learnt a lot. I don't know if I've left any clearer on what my strategy is, but it's been super interesting. And I know that a lot of people out there, whilst it might be the owner-occupier sort of strategy might be out of reach, it feels like there are other alternatives to at least get into the property market and start in alternative ways if it's not in hometown of Sydney or Melbourne or some of the capital cities. So, Sam, thank you so much. It was great.
No worries, boys. Thanks very much for having me on.
Thanks, Sam.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.